Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Remember, anything said in this piece is an opinion only. It's not financial advice, not investment advice, and here to give you purely a overall wrap indication, education to financial markets. Let's kick off. Okay, so this week got relatively quiet week, apart from GDP numbers out on Thursday in the UK and the Michigan sentiment report out on Friday in the US. You've got Jerome Powell speaking, Fred Harker speaking. So not really a lot happened economically. You've got some corporate numbers out, which will be a good indication as to where equity markets are going. But based on Friday's non-farm payrolls, which is the employment number in the US, how many jobs were created in January, which was huge. It was 517,000 jobs created versus 189,000 expected. That's going to put further pressure on the Fed to keep an eye on wage inflation. So up until now, if you remember, we've had retail price inflation and you've also had wage inflation. Now, wage inflation in the US is running at about 4.4%. So the Fed is okay and comfortable with that as long as it doesn't continue rising. However, with the non-farm payrolls coming in at 517,000, which is far higher than expected. I mean, we're talking about 330,000 more jobs were created than expected. That's going to put pressure on the Fed to raise rates even further because wage inflation will rise. Wage inflation is not going to stay in the States at 4.4%. Where there's such a demand for labor, then you're going to have an undercurrent of wage inflation. That's going to continue rising as different companies, different corporates want to attract the employees and the staff to come in there. They'll have to keep on raising the salaries and raising the hourly rates. That's going to have a big impact on the decisions that the Fed is going to make in the near future. So as I said on previous occasions, you can expect rates in the States, in my opinion, to go to 6%, 6.5% by July. I don't believe that inflation is under control. Remember, when you've got full employment, you've also got confidence and consumer spending, and the demand for goods is going to continue rising, especially luxury goods, and therefore the consumers are not going to rein in their spending, and that's going to push up inflation even further. Even though the trend for the last 2 months, 3 months has been slightly down, I think that is more of an aberration, and that's likely now to creep up as we're going to have higher retail inflation coming in for the first 6 months of the year. Talking overall about equity markets, equity markets have had a hell of a run from January. In January, I was calling that the market is going to go down. It never went down, it just shot up. Now it's a complete overbought situation. Looks like the markets have got well ahead of themselves, and there needs to be a correction in the near future, and there will be a correction starting more or less from beginning of February through to today. Overnight futures in the US were down, futures in the UK and in Europe pre-market are all down, indicating a much softer market. So I would expect overall in February for equity markets in the States to drop around about 5% in the US. As far as Europe and UK is concerned, also expecting a 5% drop there, simply because things now have got ahead of themselves of a value. Talking specifically about shares, then Meta is well overbought. Even though they're doing a buyback program, it's well overbought and looks like it needs to go all the way down in the near term to around about the 140 level. That's the next level I've got in mind, marked in, chalked in. Meta, Facebook down to about 140, and Apple's also going to float down to around about the 125, 130 level. It's again overbought and far too high. Amazon the same. Google, CRM and Salesforce all will fall around about the 5%. Now, if rates continue rising, you're going to see the Nasdaq hammered, and obviously it's going to have an impact on all of the high-risk assets. Remember, the Nasdaq and those high-tech shares are purely and totally dependent on cheap money. So all the startups and all the companies that are not yet making a profit, they're dependent on cheap money. And as money gets more expensive, and it will get more expensive throughout the year, then that Nasdaq is going to be impacted. The other area to be impacted is real estate. Now, already in the States, real estate has dropped around about 5%. It'll probably drop another 5% in the next month. So you're talking about a 20% drop this year, 25% drop in real estate in the US. For all those viewers who keep asking, where's real estate going? Real estate with higher interest rates is going to stagnate or go down, and normally follows on from a stock market crash. It has a latency thereby probably this year you'll see real estate go down in the US, UK and in Europe, and other countries will be impacted by the fall in real estate and rising interest rates and rising bond prices. Regarding cryptocurrencies, Bitcoin is struggling to get above the 23,700, 24,000 level and has come all the way back to 22,700. Looks like it's going to looks like it's going to go down to 19,000. Because it's a high-risk asset, and as high-risk assets are dumped because of rising rates or fear of rising rates, then Bitcoin and the crypto sector will go down. They've had a hell of a run, and it looks like there's going to be a lot of profit taking. It looks like they're going to float down all the way back to 19,000. Regarding foreign exchange, there is a little bit of dollar strength there on the back of the NFP, the non-farm payrolls that came in on Friday. Expectations of higher interest rates in the US, so the pound, euro, and the yen were all weaker. So cable is now running at around about the 120, 121 level. However, I'm pretty bullish on cable, and I think it will go back up to about 125, 126 in the first quarter of this year. However, Andrew Bailey did put a dampener on. The Bank of England said that rates are not going to go up or unlikely to go up much further. I think they've got it wrong. I think rates in the UK are going to go to 5.5%, and it's not yet priced in. So any type of indication of rising inflation in the UK, you're going to see the pound jump significantly. Regarding bonds in the US 10-year treasuries jumped to 354. They're probably going to go high, expecting to go to 4% by the end of February. That's my take on bonds. Anyone should be looking to go short. Go short of this market, take out some puts. Market's well overbought, and we're in for a major correction in 2023, and it will start probably in the first quarter of this year. All right, this is Mayor Valensky with Driving Markets. You can catch me on Instagram and TikTok. Share, subscribe, comment. More than happy to help. Have a good day.